Welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is titled Financial Service Update Tax Developments in China. This is the second webcast of our new Financial Service Tax series. We look forward to sharing with you a range of financial service tax topics over the next 2 months. My name is Natalie Yu, and I'm a tax partner of Deloitte China based in Beijing. And I'm now leading financial service tax service in China. I have the pleasure of hosting today's webcast. I have 4 speakers with me today: Julie Zhang, Johnny Fong, Simon Tan, and Wang Qing. Julie is a tax partner based in Beijing, and she is a tax policy leader of Deloitte China. Johnny is our financial service tax partner, and Wang Qing is our financial service tax director. Simon is our international tax partner who is also leading our real estate industry tax services in China. Johnny, Wang Qing, and Simon are all based in Shanghai. You may access to our bios on the left side of the screen. Before I introduce the agenda of today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now, let me give you an overview of our topics today. We will share the overall China tax developments and the impact on the financial service industry, followed by the tax updates on the foreign inbound direct investment into China, where we will discuss the tax developments in secondary market direct investment and the primary market direct investment by foreign investors, respectively. Let's start with the overall China tax updates that impact the financial service industry. I would bring in Julie Zhang to share the trend of China's overall tax policy and administrations in the past few years.
Sure, Natalie. As many of you know, China had the reform of its VAT rules and regulations in 2017. And the reform of its individual income tax law in 2019. China had the reform of its enterprise income tax law back in 2008. Since then, there has not been groundbreaking development in the area of EIT. The new EIT policies issued in recent years are mainly in 2 areas. One area is tax incentives encouraging innovation, research, and development. You will see this reflected in the 2022 government work report, which I will address shortly. The other area is new tax incentives encouraging certain targeted industries, as well as the development of certain locations of China. For instance, software and integrated circuit enterprises may enjoy tax holidays for 2 or 5 or even 10 years. High and new technology enterprises have been enjoying a reduced EIT rate of 15%. Location-based tax incentives are offered to the Hainan province, the Western region, some areas in the suburb of Shanghai, the Greater Bay Area, etc. These location-based tax incentives tend to relate to both EIT and while not making major policy changes, the STA has put lots of efforts on improving the efficiency of tax administration. STA refers to the State Taxation Administration, which is China's national tax authority. For instance, the STA has been using digital tools for tax collection and has been offering piloted advanced rulings. For instance, advanced rulings have been offered in the Hainan province, the city of Guangzhou, and the city of Nanjing. Thirdly, there has been increased information sharing between tax authorities and others to facilitate tax collection, such as banks, environmental agencies, public security agencies, governments, etc.
Thanks, Julie. And in Singapore and Hong Kong, there is an annual budget. And in China, every year, in the government work report delivered in the country's National Congress meeting, there is a reflection of tax policies in the year. So Julie, could you please introduce the key tax policies addressed in this year's government work report?
The 2022 government work report was delivered by Premier Li Keqiang in early March during the 5th session of the 13th National People's Congress. I will talk about 3 tax-related policies mentioned in this report. The first tax policy is offering tax cuts to support small businesses, which have been particularly affected by the COVID-19 pandemic. So the government issued these policies to help these small businesses to weather the situation. 2 specific tax incentives were announced. The first one is that small-scale VAT taxpayers will enjoy a temporary VAT exemption. Small-scale VAT taxpayers with a 3% statutory VAT rate have been enjoying a reduced level years. So this exemption is a further reduction of the VAT tax burden of small-scale VAT taxpayers. The Ministry of Finance, the MOF, and the STA have issued Bulletin number 15 to implement this exemption, making it effective from April 1st this year to the end of this year. Small-scale VAT taxpayers refer to VAT taxpayers whose annual sales subject to VAT are no more than 5 million RMB. The second tax policy to support small businesses is that for small-sized enterprises with low taxable income, their tax being in 3 million RMB will enjoy a further 50% reduction of their EIT rate. Previously, the effective tax rate of such businesses is 10% for this income bracket. This 50% reduction reduced the effective tax rate for such income to 5%. The MOF and the STA again have issued Bulletin number 5 to implement this policy. Just to give you a complete picture, based on previous existing tax incentives, for small-sized enterprises with low taxable income, the effective tax rate of their taxable income below 1 million RMB is only 2.5%. To qualify as a small-sized enterprise with low taxable income, the enterprise must meet several criteria. One of them is that the annual taxable income of the enterprise cannot exceed 3 million RMB.
Thanks, Julie. The targets of the above VAT incentive and the EIT reduction incentive are intended to provide supports to small and medium-sized enterprises. And the general thought is that it may not affect financial institutions. But we notice that some financial institutions, such as fund management companies, are small-scale VAT payers who would possibly enjoy the temporary VAT exemption. The foreign financial institutions established consulting entities to conduct some preliminary market research, coordination, and deal sourcing activities. And those consulting entities would possibly enjoy the EIT reduction policy if the consulting entity does not generate a big amount of profit. And so, Julie, what is the second policies that you would like to share with the audience?
The second tax policy mentioned in the government work report is about refund of unutilized input VAT, excess of input VAT over output VAT. The government announced that it would substantially improve the refund mechanism of unutilized input improvement in two areas. The first one is that all the existing unutilized input VAT of small and micro-sized enterprises must be refunded by the end of June this year. The set of criteria for assessing what is considered to be a small or micro-sized enterprise for this purpose is different from that for small-sized enterprises mentioned above for the EIT incentive. Given the time constraint, I will not go into the details, but want to alert you to this difference. The second improvement is that the government would issue additional measures to facilitate the refund of unutilized input VAT of specified industries, such as manufacturing, science research and technology services, protection of ecology and environment, etc. The MOF and the STA have issued Bulletin Number 14 to implement the above policy, which will help the cash flow of businesses.
Thanks, Julie. As Julie mentioned, there is a set of criteria for assessing what is considered as a small or micro-sized enterprise for the purpose of utilizing excess input VAT refund. But it is not necessarily that financial institutions are not qualified for such policy. So, for example, the CBIRC, CSRC, and PBOC set the criteria of a small and micro-sized financial institutions based on the total assets scale of the enterprise. So, for example, bank and depository entities with total assets less than 5 billion RMB is classified as a small and micro-sized financial institutions. And the securities firms with total assets less than 1 billion RMB is classified as a small and micro-sized enterprise. So we have seen some of the foreign invested financial institutions qualified this criteria. So if they have unutilized input VAT, it is worthwhile to assess whether they're eligible for the unutilized input VAT refund. And so, Julie, back to you for the third tax policy addressed in the government report.
The government also plans to offer more tax incentives to stimulate innovation and research and development activities. As I mentioned earlier, these incentives also reflect the long-term trend of China's tax policies in recent years. Three areas were mentioned in the government work report. First, the super deduction rates for R&D expenditures of medium and small-size science and technology enterprises will be raised from 75% to 100%. The MOF, the STA, and the Ministry of Science and Technology have issued Bulletin Number 16 to implement this policy. Second, tax incentives will be introduced to encourage investments in basic research. Thirdly, certain existing preferential policies will be improved. For example, the accelerated tax depreciation for equipment and instruments, tax incentives for high and new technology enterprises. Okay,
thanks, Julie. And in the last 2 years, we have seen that more and more financial service companies started to consider utilizing the R&D super deduction incentives, which can directly lead to the corporate income tax cut for the company. Although the local tax bureaus may have different views on the criteria in assessing the qualified R&D projects, it has become a consensus that financial institutions can also enjoy R&D super deduction incentive. And Julie, after talking about the tax policies addressed in the government report, can you also share the developments in the international tax area, which are also interested by the financial service industry practitioners?
Certainly. I will cover two topics in the area of international tax. The first topic is on Pillar 1 and Pillar 2. China has been deeply involved with negotiations on Pillar 1 and Pillar 2 as led by the OECD G20. And in fact, some of China's suggestions have been reflected in the latest documents on Pillar 1 and Pillar 2. Many clients have asked us exactly what China will do in response to the development of Pillar 1 and Pillar 2. Previously, China has made few public statements on the subject. But in February 2022, two senior STA officials from the International Tax Department, one retired and one currently in charge, gave an interview on this topic. The key message from this interview is that China believes in using multilateral tools to solve international tax issues, and the achievement on Pillar 1 and Pillar 2 so far is a successful example of multilateral negotiations. Unfortunately, for Pillar 2, the two officials did not say when China will adopt the income inclusion rule, the standard tax payment rule, and whether China will introduce a domestic minimum tax. Instead, they simply stated that the STA and the MOF were doing comprehensive analysis on the right choices that China should make and on a good timing for introduce the new rules into China in a safe manner. And I think people can draw inferences from these statements. Moving away from Pillar 1 and Pillar 2, now I will talk about cross-border reorganization. As many of you know, Article 7 of Bulletin 59 allows for tax-free cross-border reorganizations, and we've put such reorganizations on the slide. However, under the current rules for foreign investors, only a parent entity can transfer a PRC entity to the parent entity's directly and wholly owned subsidiary on a tax-free basis. Many foreign investors have complained about such restrictions. The good news is that the STA is considering expanding the scope of tax-free cross-border transactions, that is, lifting some of the restrictions and allowing for more types of transactions to be done on a tax-free basis. One scenario that is under consideration is a subsidiary may also transfer a PRC entity to its parent entity. Other changes will likely be made, but we know this one with some degree of certainty. Back to you, Natalie.
Thanks, Judy, for your updates on Pillar 1, Pillar 2 development in China and the relaxation of criteria for tax-free reorganization is really good news for the foreign invested entities who may consider intra-group restructurings for various reasons. Then let's move to the second part of our discussion about the specific tax developments on the foreign direct investment into China capital market. Our sharing will be covering the foreign investment into secondary market and the primary market respectively. We will have case sharing during our discussion. So let me have Wang Qing to share the developments in the secondary market investment first.
Sure, thanks, Natalie. As many of you are aware, not every foreign investor can have access to the China security market. Generally, only through the following channels, foreign institutional investors can invest into China's security market: QFI, qualified foreign institutional investor, i.e. QFI, and RMB QFI, or we called RQFI, are the inbound investment programs launched by the Chinese government in 2002 and 2011 respectively, and is now collectively called as QFI since November 2020. CIBM, China Interbank Market, as announced in February 2016, as a further step in opening up Chinese financial market to international investors. Bond Connect, which is an investment channel that gives overseas investors access to fixed income market in mainland China via trading infrastructures in Hong Kong. The program began in July 2017. MRF, Mutual Recognition of Fund, between mainland China and Hong Kong, is a scheme that eligible mainland China and Hong Kong funds can be distributed in each other's market. Intra-market connector scheme between CIBM bond market and exchange bond market, which is announced very recently in January this year. The intra-market connect refers to a scheme whereby investors of one market are permitted to buy and sell bonds tradable on the other market through the connect link between the infrastructures of the two markets. As such, foreign investors investing in CIBM can now also have access of bond listed on exchange through this connector scheme. Next slide, please. As you can see from the following two slides, the number of QFI has been significantly increased since 2020, since the new regulation on QFI has been released. And also the transaction volume on the bond connector net inflow of northbound MRF has increased over the years. Especially in 2021, the net inflow volume has nearly tripled. Back to you, Natalie.
Yeah, well, thank you, Wanqing. It seems that the investment has been booming during 2020 and 2021. So any particular reasons that behind that increase?
Yeah, actually, Chinese government has been further opening up in terms of foreign investment into secondary market. In particular, the government has gradually released the restrictions from regulatory perspective for QFI investment in China in the following aspects, starting from late 2020. Remove quote restrictions so that QFIs no longer need to apply for investment quota in advance and no need to invest within the approved quota. Relax eligibility requirement by removing the net asset requirement, minimum business operation period requirement, etc. Expand the investment scope. In addition to investing into stock, bond, foreign exchange derivatives, future index, public fund, and etc., QFI can now also invest in other financial products such as private raised fund, commodity futures, bond repo, margin financing, security financing, and security lending, and give more flexibility in terms of cash inflow outflow. A very significant change is that profit repatriation for this exercise, audit report and tax registration certificate is no longer required until the time of liquidation. A simple tax commitment letter from QFI would be able to facilitate this profit repatriation. Back to you, Natalie.
Okay, well, Wanqing, you just now you mentioned you said it is a significant change on the cash inflow and outflow for the profit repatriation. But what is the major difference between the old requirements and the new requirements for the profit repatriation by QFI?
In the past, in order to have the bank to remit the profit out from the QFI's bank account, audit report as well as tax registration certificate need to be presented to the bank. To obtain the tax registration certificate, a package has to be submitted to the relevant in-charge tax authority to demonstrate that all Chinese tax liabilities has been fulfilled for the profit amount to be registered. If there is any underpaid tax liabilities, tax filing and the payment need to be performed before tax authority can issue the registration certificate. But nowadays, this has been replaced by a commitment letter signed by QFI. As long as QFI commits that relevant tax obligations have been or will be fulfilled, the bank can process for the payment quite straightforward, which would significantly accelerate the timing for remittance. Back to you, Natalie.
Yeah, so given the above relaxation of for the profit repatriation, have you observed the market practice change? All QFIs are now repatriating cash with a commitment letter?
Yes, we do see that some QFIs are repatriating profit using the commitment letter approach, while there are also QFIs which have concerns on this approach, mainly due to the following reasons. First, now in the absence of audit report, QFI need to determine the amount of profit that can be repatriated on its own. Some QFIs would think it is better to have audit report issued on a regular basis in order to accurately assess the amount. Second, in order to issue the commitment letter, QFI need to make sure that Chinese tax compliance status of the QFI investment. As such, some QFIs may still prefer to adopt the old approach for the reason that at least the tax registration certificate will be issued upon tax authorities' review and confirmation on the tax compliance status. And also, audit report and the tax registration certificate will still be required at the time of liquidation. Therefore, instead of performing the work till the time of liquidation, having the work performed periodically may save additional time and effort at later stage. Back to you, Natalie.
Thank you. Well, I would also like to check with Johnny if you have seen any issues on the new approach for profit repatriation.
Thank you, Natalie. We do see certain issues on the new approach for profit repatriation. Now let us have a look at one of our recent cases. It is a case involving both approaches of tax registration process and tax commitment letter for profit repatriation purposes. In addition to the tax commitment letter provided to the custodian bank, the QFI in this case would like to undergo the previously usual tax registration process with the Tax Bureau on an annual basis with a view to clear its Chinese tax obligation regularly. At the end of 2021, the QFI started to prepare for the tax registration for its 2020 profit in the amount of RMB 100. It has already completed the tax registration for 2019 profit and have obtained tax registration certificate from the tax authority. As you can see from the table, its total remittable profit shown on 2019 tax registration certificate is RMB 80, with RMB 40 already remitted and the remaining 40 as remittable amount for future repatriation. During 2021, the QFI requested its custodian bank to repatriate RMB 50 from its account via the tax commitment letter, whereby RMB 20 was attributed to 2020's profit and RMB 30 was attributed to 2019 profit. Common sense-wise, we may think that now the remittable amount for the QFI 2019 and 2020's profit would become RMB 10, which is 40 minus 30, and RMB 80, which is 100 minus 20, respectively. However, this was not the case happen. We show here a table summarizing the remittance record kept by the custodian bank. As you can see from the table, the remittable amount for 2019 profit still remain as RMB 40. The tax registration certificate issued for 2020 profit record a net amount of RMB 50. Being the 2020 total profit of 100, less the amount of 50 declared in the tax commitment letter. The amount repatriated through the tax commitment letter were booked as a separate entry in the custodian bank's records and was not attributed to their respective years. Based on our discussion with the tax bureau in charge of QFIs in Shanghai, it is their practice that the amount of profit repatriated via the commitment letter is required to be deducted from the total profit of 2020 when performing tax registration for 2020. Hence, we can see from the table that the tax registration certificate issued for 2020 profit show the amount of RMB 50 only. Being 2020 total profit of 100, less the amount of 50 declared on the tax commitment letter. Meanwhile, we also confirm that for the amounts that have already been covered by the tax registration certificate, but not yet remitted, they can continue to be remitted out upon the QFI request. Hence, the remaining amount of 2019 profit of 40 is still remittable in the future. In light of the potential discrepancy mentioned just now, overall reconciliations could become more cumbersome and difficult when the QFI perform the final overall tax registration when undergoing liquidation in the future, as extended years of profit and more tax commitment letter would be involved. Therefore, QFI may want to perform reconciliation periodically with a view to mitigate its burden accordingly. Back to you, Leslie.
Thank you, Johnny. So now we have learned the current profit repatriation process and the importance of maintaining reconciliation of the commitment letter and the tax registration certificate. And the QFIs are still needing to do the tax registration and pay its tax in duty costs with the tax bureau. So Wanqing, could you share the Chinese tax considerations and the implications associated with QFI investment then?
Sure, Natalie. On general basis, for an offshore institutional investor investing into China, the major tax considerations involved would be enterprise income tax, EIT, and value-added tax, VAT. So from EIT's perspective, non-resident companies will be imposed of EIT on China-sourced income, such as interest, dividend, and capital gain. Tax rate under domestic law is 10% on above-mentioned passive income. Some treaties that China concludes with other countries' regions may offer more preferential treatment. There is current temporary EIT exemption on capital gain from equity investment for QFI and bond interest for foreign institutional investors. But the regulation does not address capital gain from other investments other than equity investments, such as capital gain from bond investment. From VAT perspective, offshore companies making investment in China is likely subject to VAT on following type of income. Income in nature of interest. Please note that bank deposit interest is not taxable for VAT purposes. And gains from transfer of financial products, such as transfer of listed shares, with a rate of 6%. There is also VAT exemptions on trading of securities by QFIs. Also, there is temporary exemption on bond interest for foreign institutional investors, similar to EIT exemption. This temporary exemption on bond interest would end at the end of 2025. Back to you, Natalie.
Yeah, so as we discussed earlier, the investment scope of QFIs have been significantly expanded. With the current tax regulations dealing with the QFIs, investment can cover the tax implications for the expanded activities conducted by QFIs.
Yeah, actually, given the expansion of investment scope, there are associated tax uncertainties toward investment. for which the current exemptions may not be able to cover. For example, gains from trading of bonds and funds may not fall into the scope of equity investment. While in practice, both tax authorities in Shanghai and Beijing may have not collected EIT on gains from trading of bonds. While for QFI's investment into mutual funds, in our experiences dealing with tax authority in Shanghai, we will look into underlying investments in the funds. For example, investment in stock, bonds, or other type of financial instruments with no EIT exemption that can be covered to ascertain the nature of such capital gain. And also, we will look into relevant treaty to see whether there would be treaty protection available to exempt EIT on such capital gain. Also, for various distribution other than stock dividend, whether 10% withholding tax would apply. For example, distribution from public fund as well as newly added privately raised fund. In practice, when fund distributions to QFI type of investors, they may not have withhold any withholding tax, which is different from stock dividend. In this sense, in practice, there is an actual case whereby 10% withholding tax has been imposed on money market fund distribution, as tax authority view that this would be China-sourced income, and there is no exemption that would apply on such type of distribution. From VAT perspective, given now QFIs are able to trade various financial derivatives, there are uncertainties as to whether those financial derivatives would fall into the scope of security and therefore qualify for exemption on trading of security. In this sense, from VAT perspective, trading of financial products are defined as trading of foreign exchange, securities, non-commodity futures, and other financial products. Other financial products may include fund, trust, wealth management product, and other financial derivatives. And therefore, strictly speaking, trading of fund unit or financial derivatives would fall into the category of trading of other financial products instead of trading of securities, and therefore no VAT exemption are currently available. There are also uncertainties around security lending, security borrowing, short selling, and total return swap, etc. That is, both from EIT and VAT perspective, whether gains from such arrangement shall be viewed as interest in nature and thus impose 10% EIT and 6% VAT accordingly. As such, in view of the above uncertainties as discussed, it would be important for QFI investors to evaluate potential tax exposure and make sure sufficient provisions are made associated with relevant tax uncertainties. Back to you, Natalie.
Yeah, thank you, Wang Qing. So just now, Wang Qing and Johnny have given us some updates about the foreign investment into secondary market. So now let us move to the primary market direct investment. So Simon, I will pass to you to share the development in the primary market investment by foreign investors.
Yes, thank you, Natalie. Typically and traditionally, foreign investors, including many foreign private equity funds, acquiring Chinese target company by setting up offshore holding SPV to hold their investment in this Chinese target company. This type of investment structure in our current context, we call it offshore PE investment structure. However, since 2011, the Shanghai government introduced China's first pilot QFLP program. Other locations such as Beijing, Tianjin, Chongqing, Shenzhen, and many more, and also more recently Hainan, have also since developed their own local QFLP pilot programs to encourage foreign investments into their own areas. As of now, there are currently around 20 cities or regions that have launched a pilot QFLP program. Foreign fund, we set up the QFLP structure mainly for commercial reasons, such as raising local RMB investment money from local Chinese LP and some also doing it from the foreign exchange convenient conversion perspective. Next slide. If you look at the statistics that shows since the introduction of QFLP program in 2011, for the first 10 years till 2021, in Shanghai, we have seen that it has attracted about 75 foreign PE firms which invest in 431 projects with a total investment amount of RMB 39 billion. Greater Bay Area is also one of the most popular areas for QFLP investment. For Shenzhen, for example, we have seen 171 QFLP management companies being set up, which manages a total of 7.5 billion US dollar. For Zhuhai, 19 QFLP have been set up with a total investment of 1.5 billion. And also we have noted that Guangzhou NASA district we have also seen 12 QFLP have been set up so far. And more recently for Hainan Haikou, 33 QFLP fund and 10 QFLP management company that owned by foreign investors have been set up to manage a total of 1.3 billion of funds.
Okay, yeah, Simon, so you mentioned that the first QFLP program was introduced in 2011, and in the past decade, the QFLP pilot program has evolved and improved significantly. Other than the increase in the number of the pilot cities, we have also seen a more mature management system as well as an expanded investment scope for the QFLPs. So with these changes, the pilot program has become a predominant route for foreign institutions to access to China active market. Simon, can you share that comparing with the offshore PE funds, what are the key attributes of QFLPs?
Sure. Well, offshore PE fund using offshore SPV to invest in Chinese target company has been one of the most popular investment structures used by foreign investors to invest in Chinese enterprises. In addition, offshore PE fund also invest in red chips companies through this structure. If we were to compare this with the QFLP investment structure, you will see that the regulation require a local fund management company, which can be, of course, foreign owned to the foreign fund management company of QFLP, whereas naturally for the offshore PE fund investment vehicle, offshore fund management company would have to be used. In relation to the source of fund, QFLP allows both domestic Chinese and foreign money can be raised, whereas for offshore PE fund structure, only non-Chinese money can be raised. Therefore, investor into QFLP could be foreign and domestic Chinese investor, whereas for the other, only non-Chinese investors are seen. QFLP structure is used to hold Chinese primary market investment, but for offshore PE fund, in addition to the private Chinese companies' investment, red chips Chinese companies are also invested by these offshore investors. Among QFLPs in different locations, the local rules also have slight difference regarding permissible investment scopes. Most cities list out the permissible investment type like Shanghai, Beijing, Shenzhen, etc. The others like Hainan provide a negative list for areas that QFLPs are not allowed to invest. The most notable difference for pilot policy in different cities is whether QFLP could be allowed to invest in ordinary share, preferred share, debt to equity conversion, which are issued by listed companies in form of non-public offering, as well as privately raised company bonds and non-performing loans. As mentioned earlier, QFLP structure is only allowed under the designated city in China, such as Shanghai and Beijing, and most recently Hainan and Xiamen, and also Guangxi, Shaogang, and Ningbo in 2021 also introduced their program.
Yeah, so Simon, just now you introduced various attributes of the offshore funds and QFLPs. And we can now move to the tax part or tax perspective. There probably is a tax difference for QFLPs from offshore funds. Any specific tax issues, implications that investors should consider in selection of these two investment structures?
Sure. This is a typical example of investment holding structure used by offshore PE fund investing directly into China via non-China intermediate offshore SPV. You will see that the offshore fund will select an intermediate holding company such as those in Hong Kong or Singapore, even a non-tax jurisdiction like Cayman Island to hold Chinese investments. From a China tax perspective, if the intention is to rely on reliefs provided by double taxation treaty afforded by China and the relevant foreign jurisdiction, it is critical that the intermediate holding company must have the relevant substance that will pass the Chinese beneficial ownership test in order to benefit from the treaty protections. In addition, as China also imposed 10% non-resident capital gain tax on exit of Chinese investment by selling the equity interest of Chinese portfolio companies, and indirect sales of the Chinese company's equity interest, i.e. selling the shares of the offshore intermediate holding company that holds the Chinese company's equity interest, would also be potentially be subject to Chinese non-resident capital gain tax under the Chinese General Anti-Avoidance Rule, we call it GAR, or some people call it Bulletin 7 reporting. Let's say Chinese GAR would not be invoked, hence there's no Chinese tax on non-resident capital gain tax. If it can be proven to the full satisfaction of the Chinese tax authority that the indirect share sales structure meets the bona fide commercial purpose, and hence no Chinese GAR should be invoked to tax the indirect share transfer. The detailed rules to prove the bona fide commercial purpose is complex, but we have seen in many cases it's not impossible to prove it if you got facts and substance to support it.
Okay, thank you. So it sounds like China tax implication on the offshore PE fund on the exits from China portfolio companies are generally 10% withholding tax on the capital gain, and indirect transfer will be subject to same 10% withholding tax if GAR is invoked. And so how about the situation for the QFLPs?
Yes, for a typical QFLP fund, it will be managed by a locally incorporated GP, but such GP may also have foreign shareholders, and it raises funds from both domestic and foreign LPs. According to the general rule, for a local established partnership, which is applicable to QFLP, incomes are generally not taxed at the partnership level, but rather in the hands of the partners themselves. So this is a see-through, a transparent entity, as we call it. For individual partners, it will be subject to individual income tax, while for corporation partnership, it will be subject to enterprise income tax. The tax rule regarding partnership are a bit ambiguous in China. As such, there are some tax uncertainty for foreign partners. Income may be derived by the QFLP mainly include capital gain from equity transfer, dividends received from invested companies, and other investment income such as interest. The first uncertainty is whether dividend income should be treated separately and included as business income of the partnership. In practice, in absence of any explicit tax rule, tax authority may treat the dividend income as ordinary income of partnership. For Chinese and foreign individual LPs, the investment income from the QFLP RMB fund would be taxed at a progressive rate from 5% to 35%. The rate applicable to production of business income of self-employed, industrial, and commercial household. If dividends are treated separately, it will be taxed at 20%, which is the rate applicable to capital gains under the individual income tax law. However, if it's included as ordinary income, it will be taxed as progressive rate from 5 to 35%. Where the LPs are Chinese incorporated enterprise, the investment income and capital gains will be subject to EIT rate at 25% unless reduced by any tax incentive granted to such Chinese companies. The dividend income received currently is hard to get exemption from EIT, given that the tax authority holds the position that dividend distribution through a partnership is not treated as a direct dividend distribution between two tax resident companies. So potentially there is a double taxation here. For foreign LP, if no PE is constituted in China, the income from the QFLP will be subject to 10% withholding tax. And if the foreign LPs are tax resident in the foreign jurisdiction and also qualify as beneficial owner for the income received, provided there is an applicable tax treaty between China and the foreign jurisdiction, the preferential withholding tax rate under the tax treaty may be applicable, and hence potentially it can be exempt. However, if a PE of foreign LPs is deemed to be constituted in China, the income from QFLP will be attributed to the PE and subject to 25%. So therefore, it's critical for foreign LP to ensure that it does not have a PE in China in order to be potentially to enjoy either 10% tax rate or even exemption under the tax treaty.
Okay. Thanks, Simon. So, yeah, so it looks like the tax implications for the foreign LPs of the QFLP is not that straightforward, right? Where the permanent establishment issues for the foreign LPs need to be considered. We have also seen more complicated situations where the foreign LP is an offshore fund dedicated investing into China. And there is an offshore GP of offshore fund, which may actively participate in the fund investment activities in China. Is there any special tax considerations for this situation?
Yeah, so in some cases, a foreign GP may also be added into the fund structure, which may cause additional complexity in terms of tax treatment. So this for foreign GP is more likely to constitute a PE in China comparing with foreign LPs, either because of any activity carried out in the process of performing the duties as GP in China or the activities performed by the domestic GP, especially when the foreign GP and domestic GP are related parties, or domestic GP is regarded as dependent agent of foreign GP. If a PE of foreign GP is constituted in China, the investment income and income from the managing of the fund, i.e. management fee and carry interest, will potentially be subject to 25% enterprise income tax in China. However, if it can be argued that no PE is constituted in China, technically the management fee and carry interest should not be subject to income tax in China. But in practice, we tend to see tax authority either will argue there is a PE of foreign GP, or they will still intend to impose a 10% at minimum withholding tax on income from QFLP. In the kind of double tax GP scenario, if both domestic and foreign GP are responsible for certain activities, it is important that function and risk are appropriately allocated and assumed. They should be mindful that from a transfer pricing perspective, fair market management fee and carry interest should be split between foreign GP and domestic GP. Otherwise, potentially this may again attract transfer pricing challenges as well.
Thank you, Simon, for sharing. And in addition to the foreign direct investment into primary and secondary market, we also have seen foreign fund managers to apply for fund management license locally in China and raise funds or issue financial products domestically with the background that China further opening up financial industry to foreign investors. And Johnny, could you share with us the developments in this area and also the tax-related issues that you have seen?
Thank you, Natalie. Like you said, in recent years, China has been further opening up its foreign financial industries to foreign investors. They include private fund management, public fund management, as well as wealth management, which offer considerably more investment avenues and opportunities to foreign investors in China. In this slide, the table here summarizes certain attributes of a couple of specialized financial enterprises, namely private fund management company, public fund management company, and wealth management company. I would like to draw your attention that one of their common features is that the duration of their approval generally exceeds 6 months, which is much longer than a normal foreign investment enterprise. as special pre-approval procedures will be required by the relevant financial regulators. Next slide, please. The case that I would like to share in these 2 slides is about deferral of withholding tax on dividend reinvestments by foreign investors. The Chinese government aims to create a better tax environment for business and encourage the foreign investors to expand their investment in China. Therefore, the State Administration of Taxation announced tax policies to allow qualified foreign investors to enjoy preferential policy of withholding tax deferral on dividend reinvestments. In order to benefit from the deferral withholding tax treatment, both the foreign investors and the Chinese enterprise declaring dividends should perform relevant filing formalities with the local tax authorities. Relevant tax registration materials are required to be submitted to the in-charge tax authorities within 7 days from the date of capital injection through dividend payment. However, in light of the prolonged duration of approval for financial enterprises, which may well exceed 6 months, we noticed that some of the foreign investors could not completely fulfill the required tax registration requirement within 7 days from the date of capital injection through dividend payment. Next slide, please. Here, we share a case whereby we assisted a client in securing deferral of withholding tax for dividend reinvestments in setting up a financial enterprise in China. During the preparation of a new company, Company B, we had various discussions with the in-charge tax bureau with a view to ensure they are well aware of the prolonged approval time frame for a financial enterprise to be officially established, and therefore the practical as well as the practical difficulty in meeting the 7-day timeline with respect to the tax registration requirement. After rounds of communications with the in-charge tax bureaus, we managed to convince the tax bureau to accept the tax registration package, despite they were submitted long beyond the 7-day requirement, and secure the deferral withholding tax treatment on a case-by-case basis. As in other controversy situations, maintaining good relationship and continuous communication with the in-charge tax bureau is highly important. Back to you, Natalie.
Thank you, Johnny. This brings us to the end of this discussion, and we now have some time to respond to some questions from our audience. Let me take a look at whether we have the questions from audience. Okay, I see 2 questions. The first question is related to QFLP. So, Simon, I'll let you know what the question is. The question is comparing both direct offshore PE structure and the QFLP structure from the foreign LP investors and the GP perspective, which structure would provide more tax efficiency to them? So, Simon, can you address this question?
Sure. This is indeed a very good question, and we get asked a lot. I would say that for foreign LPs, under current practice, it is possible to obtain the same tax result, i.e. 10% tax treatment at minimum for most foreign on capital gains and dividend income. This is the normal case, but of course, if there's a treaty, you might be able to get it to 0. However, from a perspective of from GP, QFLP structure would more likely, in my view, lead to the foreign GP to be challenged by the Chinese tax authority under the PE risk, hence potentially be subject to 25% EIT on its income. This is because the Chinese authority always believe that foreign GP, by the fact that they're managing fund in China, they should effectively creating a PE. So that is a kind of general belief. So this is in contrast with the offshore PE structure, where typically we see that offshore GP will have fund management company overseas, and then they may set up a Chinese so-called sub-advisor company under the fund management company, and there will be a sub-advisor contract. And therefore, the Chinese sub-advisor company will be compensated and paid for on a cost-plus basis. And as long as all the so-called PE-sensitive decision-making and processes are all properly managed, I'm sure that it is possible to structure that there's no PE in China. And this is very happen all the time. We see a lot of foreign funds, that's how they do it, and they don't pay China tax. And I've not seen the real challenges in terms of Chinese authorities saying that there is a PE of the Chinese foreign fund management company, which have a so-called sub-advisor company. So I would say all in all, notwithstanding the QFLP is a good structure, but we tend to see it more people setting it up from the perspective of either they want RMB money from a local Chinese LP, and therefore they set up a so-called QFLP, or because of foreign exchange conversion, they can convert their money when on the way in, and then they can just use it to invest freely, rather than each time they have to invest and ask for permission for conversion. So it's really, in my experience, we've seen this as more like people using QFLP more from a perspective of commercial purposes rather than for tax purposes. Back to you.
Okay. Thank you, Simon. And the second question is related to the QFI, the tax uncertainties on QFI. And Wenqi, the question, probably, I think the question is addressed to you. So the question is, as you discussed earlier, there are uncertainties associated with expanded investment scope by the QFIs. And do you expect there will be new tax circular announced clarifying those uncertainties? Wenqi, can you answer this question, please?
Yeah, sure, Natalie. Yes. And actually, when the regulation on the bond interest exemption was issued in November last year, there was an expectation that the new circular may provide clarification on tax treatment in association with the above new financial product added. However, the new circular only provides extended exemption on bond interest only. And now industry players are also working together, trying to communicate with STA on the above uncertainties, aiming to get those uncertainties clarified as soon as possible. But it could be the situation that there would still be tax uncertainties exist until there is further clarifications from tax authority.
Okay. Thank you. Okay. Thank you, Wenqi. Okay, and that unfortunately is all we have time for today. So as we mentioned in the beginning, today's webcast is part of our financial service tax webcast series. And we focus on the tax issues on foreign direct investment into China capital market today. And in our future webcast, we will have more discussions on the tax issues, developments for the local tax issues on the locally incorporated financial institutions, the tax audit, trend focus, the transfer pricing issues, the tax issues for the partnership, contractual financial products, etc. So stay tuned. And Julie, Johnny, Simon, and Qing, thank you, and special thanks to all of you who were able to join us today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily, and tell us what you think about today's program. If you join us late, please note that the presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debrief webcast. We will respond to all the questions submitted during the webcast in a couple of days, in a couple of weeks. Also, if you think of any questions or comments later, please feel free to reach out either to me or to our speakers. We would be more than happy to talk to you. And please don't forget to tune into our next scheduled webcast from the Tax Technology on 14th April, titled SAPS for HANA, SAP Document and Reporting Compliance. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye.